This is Horizon's Middle East and Africa. Our top stories this morning. Tough talk. U.S. forces strike Iranian targets for a 10th straight day after President Trump says Tehran will pay for the killing of 3 American soldiers. The conflict looks set to expand as Iran-backed Houthi militants in Yemen threaten to blockade Saudi shipping in the Red Sea. Fresh tariffs. The U.S. plans new 50% levies on some Canadian goods, saying its northern neighbor has unfairly treated American alcohol, cars, and dairy. Plus, flying high. Airline and airport operators meet in Farnborough for the biennial air show. We hear from the Turkish airline chairman and Dubai Airport's CEO. It's just gone past 8 a.m. across the Emirates, 6 a.m. here in South Africa, where I am. I'm Jennifer Zabisanja in Johannesburg. We have plenty of news to get you throughout the morning. But first, of course, we want to take a check on where markets are right now. If we take a look at U.S. equity futures, pulling back slightly, as you can see, up just about 0.4%, a noticeable reversal from what we saw last week, but then also from what we did see throughout the session on Monday, though we did see chip makers staging a noticeable comeback, especially after last week's sell-off. Of course, we know that was the name of the game last week for volatility, but on Monday we did see the S&P 500 still closing at its lowest level since late June. Interestingly, though, we did hear from Goldman Sachs saying that hedge funds have been pulling back from U.S. tech stocks, rotating into other sectors at a record pace over the past few months. We've seen that reflected in some of the price action, and that will be key, especially as we go through earnings throughout the week. The energy complex is also adding to a bit of caution in the markets right now. As you can see right now, oil, Brent crude is down just about 0.8%. We've been seeing oil fluctuating, though, between gains and losses, especially as the conflict in the Middle East continues to escalate. The market increasingly pricing a cycle of what we've been seeing over the past 10 days now of attacks and potential reconciliation rhetoric that we are getting. So one to pay attention to. Brent crude just over $88 a barrel there. The U.S. 10-year yield marginally lower right now, though what we did see on Monday was, interestingly, bonds were under pressure. And adding to some of the pressure were comments that came from the new U.K. Prime Minister, Andy Burnham, suggesting potentially a bit of flexibility. He used that term, that leading to a bit of trepidation for gilt markets, and that spilling over into sovereign bonds across the world and across the curve. The U.S. 10-year yield at about 4.59% there. And we have the Bloomberg dollar on the board as well, unchanged, though we are keeping a close eye on the currency, especially as we now see tariff concerns are back into the fold. Now let's check in on how markets in Asia are faring. Winnie Xu is standing by in Hong Kong for us. Winnie, what are you watching this morning?
Good morning, Jen. We are seeing a very nice rebound in Asian stocks today, with the benchmark up more than 2% after having been sold off for the past 3 days, and also being supported by oil prices easing a little bit. Now we have Japan coming back online after a holiday, but leading gains today is really South Korea's KOSPI index, here up 4.6%. Earlier, we did hear from the exchange triggering a sidecar to hold the trading after such sharp gains. But today, what we're really seeing is foreign investors stepping in to buy while retail investors sell. So that foreign buying also supporting currency here, with the South Korean won strengthening against the U.S. dollar. And in fact, it is leading Asian peers today, and also the best performing Asian currency so far this month, supported also by that hawkish stance of the central bank, as well as those strong trade data that we saw this morning. Now, flip the board, we also take a look at another bright spot today, which is the onshore stocks here in China, with the CSI 300 as well as the Chinex index both extending gains from yesterday, supported by Beijing stepping in to stabilize the stock market with the help of insurers and also these state-backed funds. Now, we are also seeing some gains when it comes to Zhipu, saying that the company has completed a data center used just local chip makers, chips. So that's why we are seeing local chip makers also gaining as well. Back to you, Jen.
Thanks so much, Winnie Xu in Hong Kong. We'll check back in with you in just a bit. Now, the U.S. says it's completed a 10th day of strikes on Iran after President Trump promised Tehran would pay for the killing of 3 U.S. soldiers. But the conflict could expand further, with Iranian-backed Houthi militants threatening to blockade Saudi Arabian shipping in the Red Sea. The Saudis' use of that export route has helped limit disruption to global oil supplies. Joining us now is Stuart Livingston-Wallace, executive editor for the Middle East, North Africa, and Russia. Stuart, let's just start with these latest strikes. What exactly were they hitting, and what has been the response given the escalatory measures that we've been seeing over the past few days?
Yeah, so I mean, it was largely the same sort of suite of targets as you've seen in the previous 9 days. So US CENTCOM was saying that they were basically targeting military command centers and other military assets, largely on the coastal regions and largely around Hormuz. So clearly designed to diminish Iran's capability of attacking shipping. But if you want sort of some indicator of how effective these 10 days, or rather nights, of bombing have been with regard to shipping, there were reports of basically 2 separate ships attacked overnight, one late last night, one this morning, one off the UAE and one off Oman. So clearly there's no decline in Iran's ability to continue to threaten shipping, and it's very hard to see going forward how many more nights of US military attacks will it take before that capability is eliminated completely. One would think that it might be almost impossible.
And now adding to more of the tension, Stuart, is this threat from the Houthis. How much does that change the calculus of the various sides that are involved?
I mean, it's a big deal. It's a big deal assuming it happens. Now, one thing that must be said, an important caveat is that the Houthis have said this sort of thing several times over the last several months, and by and large have not carried through with it. That is not to suggest that anyone should be complacent about this latest threat. There is obviously a long track record there of the Houthis attacking shipping, and maybe even just the mere threat of an attack is enough to deter most shipping companies from going through the Bab el-Mandeb Strait. If that does happen, in effect, what you end up with is a blockade on the Hormuz side, a blockade on the Red Sea side, and it more or less paralyzes shipping. Most importantly, of course, it potentially crimps Saudi Arabia's ability to get oil out into the global markets from the Red Sea ports. And that itself has been something of a lifeline in terms of the millions of barrels that they've been able to get out there. So, look, it's something we'll watch over the next couple of weeks. Clearly, it's impactful, and it's something the market needs to pay a lot of attention to.
Stuart Livingston-Wallace, Bloomberg's executive editor for the Middle East, North Africa, and Russia. Stuart, thanks so much for starting us off. Now, joining us to discuss this further is retired Lieutenant General Karen Gibson, an advisor at Academy Securities Geopolitical Intelligence Group. Lieutenant General, thank you so much for your time. So there are quite a bit of conflicting messages about what is driving this latest escalation on the part of the U.S. How do you view this?
So that's a great question, Jennifer. The initial aims of the campaign were to conduct such destructive strikes against Iran's military and leadership that it would compel them to make concessions at the negotiating table that would lead to enduring curbs on their nuclear program. This latest phase is a battle for who will control Hormuz, a far more narrow aim made critical by the chokeholds that Iran has put in place on shipping that flows through the Straits of Hormuz. It is a battle for Iran saying that they insist that they will play a role and they will determine who goes through the strait, and the United States seeking to restore the normal flow of international commerce through a strait that was previously free and open.
And we have seen the strikes now even expanding beyond just military targets, as we heard from our Stuart Livingston-Wallace. Do you not see that as a complication of any sort of mediation efforts?
Well, I think before we can even get to mediation, we really need to achieve some kind of success in this aspect of the campaign. And whenever I look at what an adversary might do, I look at 2 aspects. 1, what is their will and intent, their desire? What are they hoping to achieve? And 2, what is their ability to do that? Their will and intent, clearly stated and consistently reiterated, is that they want to control traffic through the straits. Their ability to do so is very difficult to eliminate, as your previous speaker said. The United States has had tremendous tactical success in destroying a lot of capability, but totally eliminating it, that's an incredibly high bar. Iran has a number of asymmetric advantages in this regard. It's one point in space, the Strait of Hormuz, that we seek to secure, but they have a vast geography from which they can launch attacks. And the kinds of one-way attack drones that they're using are relatively inexpensive, easy to replenish, easily concealed, and have limited signatures associated with them until they're actually launched. Completely eliminating that is very difficult. And so despite the precision and lethality of these American strikes, they've only made a dent in that capability. In terms of intent, I think there's been no success thus far. Iran continues to insist that they'll control the straits. They continue to strike back at bases in Gulf partner nations, and they have made no indication that they are willing to budge in this regard.
Well, and we're now hearing some reports that Pete Hegseth has gone to Capitol Hill to ask for more funds to cover some of the war costs. So what do you see then as the greatest challenge for the U.S. military campaign as we are now in a 10th day of these escalatory strikes?
So I think the greatest challenge is that it is largely at this point a military campaign. It needs to be multifaceted. It should probably include some financial penalties. You know, I know we've gone back to invoking some recent sanctions against 7 entities as well as diplomatic efforts. And it's unfortunate that it's not a more multinational effort, because there are a couple of areas where I think people tend to forget that for the men that are leading the Islamic Republic, this is an existential threat for the survival of their state. And so there is an underestimation of their willingness to absorb pain, whether it is in the shape of years-long sanctions or punishing airstrikes. And so continuing to attack these assets that are being used to affect shipping is probably not going to be enough to change Iran's strategic calculus. One more facet that I would throw in this, you know, the president can say the straits are open, Iran says they're closed, but who really at the end of the day determines the status of shipping through the straits is commercial shippers and the companies that insure them, as they weigh the potential for profit against the perception of risk. And Iran doesn't have to do much at all to raise the perception of risk. And that will be a very difficult matter to resolve and to restore commercial confidence that it's a consistent ability to sail through the straits, not something that is episodically protected.
And in terms of restoring, what do U.S. Gulf relations look like in the near term? How do you restore some of the confidence, if there ever were confidence, between some of these nations and the U.S.?
So I think it's not really, I wasn't thinking of it in terms of the confidence of Gulf allies. I was thinking in terms of confidence of business interests that are paying for the shipping costs or for insuring, you know, vessels that are flagged from many, many nations. I do believe there is still a strong relationship between the Gulf partners and the United States, because there has to be. And this is another area of tremendous asymmetry in that they are the ones that are absorbing the cost of these strikes as Iran reaches out and retaliates against Gulf nations that are hosting or supporting the United States. Iran's strategy is to make the campaign so politically and economically untenable for the United States that the U.S. changes its campaign plan. And part of doing that is by punishing those states, by showing that the United States cannot protect them, and by trying to compel the Gulf states to pressure the United States to try a different tack.
Really valuable insights from you. Retired Lieutenant General Karen Gibson, advisor at Academy Securities Geopolitical Intelligence Group. We really appreciate your time. Thanks so much. Now, still ahead, Neovision Wealth Management tells us why they expect realized oil volatility will run higher than markets are pricing. Their CEO joins us next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. Traders are tracking a pullback in oil after U.S. forces struck Iranian targets for a 10th day. This comes as markets watch for disruptions to Saudi Arabian exports following Houthi militant threats to blockade an export route through the Red Sea. Let's bring in Neovision Wealth Management CEO and co-founder Ryan Lemand joining us now. Ryan, thanks so much for being with us. So we were just mentioning we are seeing a bit of a pullback in Brent crude, but your notes actually say that you suggest the markets may be underpricing the cost of a delivered barrel. Can you just explain what you've noticed?
Yes, completely, Jennifer. The first thing is that refined products of oil are getting in shortage here in Europe. So I arrived on Sunday to Paris. The taxi had to stop for 25 minutes outside of Paris to fill up in diesel because inside of Paris, there's no more diesel. So clearly, it's a problem not only of delivery of oil, but the refining of oil. The top refining countries like US, China, Russia, South Korea, India, they all refine from themselves. Russia's refineries are like pretty much destroyed. So there are tens of millions of barrels of oil on water right now that are useless because they cannot be refined. So the reserve to use is getting in shortage.
What does that mean for prices, Ryan? Do we continue to see volatility between the $88 to $90 a barrel, or is your expectation it might go higher?
I think the paper oil price that we see on screen is not really reflective of reality. When you want to buy today gasoline or diesel, it's still trading at a price as if oil was more than $100. And with all of the risks that your previous guest has mentioned, the potential closures of other straits, I think oil prices should be much higher than they are right now. Absolutely.
What is that point, though, Ryan? What are you expecting?
We should see around $100 a barrel, and if the Houthis they close the Bab el-Mandab Strait, I think we should see around $150 a barrel. We're talking about around 30% of global oil supply of oil and gas. Add to it the refined products like gasoline, like diesel, like helium, which is essential to the manufacturing of chips, will be in very serious shortage.
Ryan, then what's your expectation for when we see this maybe showing up, the premium on crude showing up in CPI and PPI prints? Last week we got softer prints, but your expectation is that this may start to change soon.
Yes, absolutely. So what we observe when we have a very large energy shock, it translates into CPI and PPI between 3 to 6 months later. It's always quite delayed. So we've seen a much better than expected print on the last one, which I have a question mark on. But we should expect its appearance again before the end of the year, sometime between September and December in the fourth quarter. Let's hope it's not as bad as I think it will be. But I think it will show up by Q4, unless there's a resolution of the conflict that is very quick, where producers and suppliers would adjust the price accordingly.
Does that change your allocation then, Ryan, for your portfolio?
At the moment, yes, we've reduced risk into the summertime and with the escalation that we've seen. So we've reduced substantially anything that we consider as overvalued, because generally overvalued assets are the ones that suffer the most, whether in volatility or drop in price in case of issues. And we're going into much less volatile assets like short-term bonds, Swiss equities. So anything that is decorrelated with the market, decorrelated with the energy sector, that might suffer from huge volatility.
We of course are in the midst of earnings season. I know you're underweight U.S. right now. What would you need to see throughout some of these earnings results to maybe change your exposure then?
So we're all waiting for the AI sector to start showing some very good results. So basically what we're seeing is a financing by hyperscalers into AI companies. So enormous amounts of cash flow, free cash flow is going to these companies. And we are yet to see this business model as sustainable and revenue generating. So at the moment, I'm paying $200 a month of subscription with an AI company. while I'm consuming $5,000 a month in tokens. So this subsidy model is not sustainable unless we see these AI companies showing real profitability and no need for subsidies anymore done by private equity and VC houses. So this is what I would like to see more, to have more faith that the overvaluation that we're experiencing in the US, well, it's justified and it shows future revenue generation of these companies.
And we'll see how those earnings pan out. Thanks so much, Ryan Lemand, as always, for joining the show, CEO and co-founder at Neovision at Wealth Management. Great to have you. Now, still ahead, tariff tussle. President Trump plans 50% levies on some Canadian goods. He says America has been unfairly treated by its northern neighbors. The details later this hour. This is Bloomberg. Welcome back to Horizons Middle East and Africa. The new UK Prime Minister, Andy Burnham, has made several appointments to his cabinet. John Healey, the former defense secretary, replaces Rachel Reeves as Chancellor of the Exchequer. His appointment was unexpected and comes weeks after he resigned in a row over funding with the Treasury. Shabana Mahmood remains Home Secretary, a role she has held since September, and oversees immigration policy. Former Labour leader Ed Miliband takes over as Foreign Secretary. Miliband replaces Yvette Cooper, who has since been appointed Health Secretary. The EU has fined Alibaba's e-commerce service nearly $630 million for failing to adequately police illegal, unsafe, and counterfeit products on the platform. The European Commission says AliExpress did not do enough to remove repeat offenders or enforce its own penalties. Alibaba says it's surprised by what it calls a disproportionate fine and is planning to appeal. And a group of 12 U.S. states have sued Paramount Skydance, seeking to block its $110 billion bid to buy Warner Brothers. The antitrust lawsuit alleges the deal would harm competition for film distribution and leave viewers with higher prices and less choice. Paramount Skydance has responded to the suit, saying it would defend the transaction in court. Now, let's take a look at where your markets are trading at this hour. Right now, as you can see, a bit of a reversal for U.S. equities. Euro Stock 50 futures pointing marginally lower right now, though, of course, that is a welcome sign, at least the bounce that we're seeing in U.S. equities from a lot of the trepidation last week in markets. Now, coming up, the CEO of Dubai Airport says that the Iran war has made little impact on operations. We'll get more on that conversation next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Tough talk. U.S. forces strike Iranian targets for a 10th straight day after President Trump says Tehran will pay for the killing of 3 American soldiers. The conflict looks set to expand as Iran-backed Houthi militants in Yemen threaten to blockade Saudi shipping in the Red Sea. Fresh tariffs. The U.S. plans new 50% levies on some Canadian goods, saying its northern neighbor has unfairly treated American alcohol, cars, and dairy. Plus, flying high. Airline and airport operators meet in Farnborough for the biennial air show. We hear from the Turkish airline chairman, as well as the Dubai airport's CEO. It's just gone past 8:30 a.m. across the Emirates, 6:30 a.m. here in South Africa. I'm Jennifer Zabasanja in Johannesburg. We will get you those interviews in just a bit, but let's just check in on where markets are trading at this hour. Right now, U.S. equity futures pointing higher, reversing some of the earlier losses, though we did see the S&P 500 close lower on Monday. Some of the risk, some of the concern around sentiment, of course, is what is escalating in in the Middle East. We did see the S&P closing at its lowest level since June. Still some of the questions around AI spending percolating throughout the markets, but perhaps we're seeing some investors coming back into the fold. Though we did get a report from, or a note from Goldman Sachs saying that hedge funds have been pulling back from U.S. stocks and rotating into other sectors. We'll see how that plays out as we get more earnings throughout the week. Brent crude right now adding to some of the caution in the markets, although down just over 0.7%. We've seen oil fluctuating over the past few days. Right now, Brent crude just over $88 a barrel. The U.S. 10-year yield is reversing some of the earlier losses, down right now. We did see a bit of concern across the curve for sovereign bond markets globally on Monday, especially as we did get some comments from the new UK Prime Minister Andy Burnham suggesting some fiscal flexibility, and that adding to a bit of concern for markets globally. The U.S. 10-year yield at about 4.59% there. And the Bloomberg Dollar Spot Index trading sideways, though, watching it closely as trade tensions continue or pick back up, I guess, between the U.S. and Canada at this point. Let's, though, check in on how markets in Asia are faring. Winnie Xu is in Hong Kong for us. Winnie?
Yeah, good morning, Jen. A very nice rebound in Asia today with the MSCI Asia here up 2.3% after 3 days of tech-led sell-off and also actually having its best day in about a month. Now we have Japan coming back online with the Nikkei 225 up 2.6%. Now this is coming after the gauge, in fact, hit a technical correction territory just last week. South Korea's KOSPI index leading gains today up 4.5% here with foreign investors buying as retail investors continue to sell. But that inflow is also supporting South Korea's Korean won here, which is in fact Asia's best currency so far this month. Also supporting sentiment in South Korea is that trade data that we got earlier showing that July 1st to 20th, a jump of 63% in exports. So that is actually a record compared to any other year for the same period of time. So really being driven by that AI demand. Flip the board, we take a look at another bright spot in Asia, which is in Chinese stocks. We are seeing onshore stocks gauges specifically extending gains after Beijing really step up their support to stabilize the market with the help of the national team as well as the insurers and also the state-backed funds. Now, also the strength are being seen in some of the technology names here. We have Zhipu, which is China's AI model maker, and it actually said that it has just constructed a data center used only local chips. So that is supporting local chip makers as well. Back to you, Jen.
Thanks so much, Winnie Xu in Hong Kong for us there. Thanks. Now, the Trump administration has vowed to impose a fresh 50% tariff on some Canadian goods over what it said was unfair treatment of American alcohol, cars, and dairy. The items subject to the new tariff include milk, hockey equipment, beer, and plywood, but not major resource imports such as energy. The levy, set to take effect in 30 days, marks one of the most severe trade actions the U.S. has taken against their second largest trading partner. To discuss further, I'm now joined by Bloomberg Chief Asia Correspondent, that's Rosalind Matheson. Ros, thanks for being with us. Maybe just start by giving us a bit of context as to the legal framework that was allowed to allow for these tariffs to be in place. What is behind this?
Well, it's interesting because it comes at the same time as the US president was, in fact, threatening tariffs on Canada over wildfire smoke that's been blowing into the US. But the US administration says that's separate. That may yet be action to come. This action would be under Section 338 of the 1930 Tariff Act, which in theory allows the US president to impose duties of up to 50% on countries deemed to be discriminating against the US. And this is a measure that's not actually been used, it seems, before for such action, so it's legally untested, and it comes against that broader backdrop of tensions over the future of the relationship and the trade agreement between the US, Canada and Mexico, which the US has said that it won't extend. It's now on a rolling basis, so it feeds into all of those negotiations. But as we've seen, it's not yet imposed. The US administration says 30 days before it is, and we know that 30 days is a long long time when it comes to the trade decisions of the US, so anything could still happen.
Yeah, of course, and especially from the Canadian perspective, we're looking at what Mark Carney, the Prime Minister, has said. What is the likelihood then of retaliation?
Well, certainly this is going to irritate Canada. It comes against that backdrop of tensions, and particularly between Donald Trump and Mark Carney. You already have the Premier of Ontario, Doug Ford, coming out and saying if this does get enacted, Canada does have to retaliate. But this would represent a pretty small part of the bilateral trade relationship, which was in goods and services around $900 billion last year. These products don't represent a significant chunk of that, which might be a factor for Canada in thinking about how to respond. There's also the possibility, again, that Donald Trump changes his mind, which they've seen before, which might encourage them to take a bit of a wait-and-see approach in this. You can see that Mark Carney says, yes, Canada, in his view, has matched what he calls unilateral US actions so far, but he also says they proposed a whole lot of things to try and resolve these trade tensions, and they're very willing to keep talking. So that sounds like a placeholder kind of comment to allow them a bit of time to see how this is going to play out.
Yeah, certainly still unfolding there. Rosalind Matheson, thanks so much for walking us through it, though. Appreciate it. Let's turn back to the Middle East, though. Oil prices are steady as traders watch for disruptions to Saudi Arabian exports after Houthi militants threatened to blockade an export route through the Red Sea. The Saudi-led coalition in Yemen says it has taken steps to protect vessels from a move that could put the flow of millions of barrels of oil at risk. Let's bring in Bloomberg oil and shipping reporter Rong Wei Neo. Rong, let's just start with this. What sparked this move from the Houthis? What have we heard?
Well, essentially, the move by the Houthis to blockade these Saudi Arabia-linked ships come as a point of retaliation after Saudi Arabia has attacked an airport in Yemen. Of course, that's just one point, or I would say a point of conflict in the wider what we are seeing in terms of what's happening in the Middle East. That's because for the Houthis, they're backed by Iran. And of course, some analysts would actually speculate that the Houthis are being used by the Iranians to kind of push for further disruptions in shipping lanes. Firstly, we already have Iran, who is blocking off shipping channels at the Strait of Hormuz. And now with this latest blockade, there is increasing fear of there could be disruptions on ships carrying oil transiting through the Red Sea. And but however, as you can see from oil prices, oil markets, or rather oil traders, have been taking these in their strides. That's because if we look at a wider landscape of what's happening in the Middle East, there have also been some hopes that through mediators, we have heard that perhaps Iran is hoping to broker some sort of temporary ceasefire, or at least there are steps being made to kind of push towards some kind of a conclusion after the US have launched multiple strikes on the region, and many oil traders are keeping a close eye out for that.
Well, but we are still, as you were pointing out there, we are still keeping a close eye on the price action of oil. But what are the potential ramifications, though, if we do continue to see a threat to oil flows?
Right, so the latest blockade by the Houthis did raise some alarm bells for oil traders. That's because the Red Sea is essentially the channel where Saudi Arabia, of course, one of the major oil exporters in the world, they have been using this alternate routes. Rather, they have this alternative pipeline bringing oil from their oil fields to this port called Yanbu. And from there, several of the major oil importers here in Asia have been continuously getting crude oil from that port, effectively bypassing all the chaos that has happened in the Strait of Hormuz. So naturally, when this blockade happened, a lot of the traders' first thoughts will be on what's going to be happening with the oil flows coming out from Yanbu. Is this a bigger issue? But as of now, from what we are hearing from traders that directly deal with cargoes coming out from that port, it seems that oil loading operations are continuing as per normal, and these Asian customers are still waiting out for further directions or further indications from the Saudis on what they should be doing, or are there perhaps alternative routes that these ships could take, which is why we can see that the price action of oil has been relatively stable, and we haven't quite seen any other further catalysts that could actually push oil prices up further.
Great analysis there. Bloomberg oil and shipping reporter Rongwei Neo. Rongwei, thank you so much for your time. Now, the Farnborough Air Show continues for its second day today, with the global disruption of the Iran war taking center stage. Bloomberg TV anchor Guy Johnson sat down yesterday with Dubai Airport's CEO Paul Griffiths. Here's what he had to say on the war's impacts.
Operations completely normal. I've checked in again this morning just to make sure that is still the case, and it is the case. We're operating at pretty much full capacity. Emirates have actually got over 80%, probably closer to 90% of their regular scheduled operations. And when I went through late last week, the airport was as busy as ever. I mean, we're facilitating more than 6 million customer journeys since the conflict began, and I think things, if you look at on the ground at DXB, there's no suggestion that there's a problem, and we'll continue to operate. Obviously, airspace is still subject to some restrictions going to the north, but we've got plenty of other air routes across Saudi and out to the south, so air operations are continuing as per normal.
Do you think you will continue to use those routes? Is that going to become the new normal? Is that the way out, effectively, and the way in?
Well, until there's a long-term stable situation and those routes across Iran and Iraq are available to us again, yes, but it's not a huge problem at the moment. We certainly have enough capacity via the alternative routes to be able to mount a very stable and normal operation.
What are the latest numbers in terms of passenger figures? You talked about Emirates being back, but what about some of the other carriers?
Well, we're about 50 airlines now. That's about half of the normal number, but actually a lot of the additional capacity that Emirates has put on is covering for those airlines. Pretty much all the foreign airlines are coming back very strongly. We're seeing 10-20% growth, and that's a fairly good number, because obviously it means that we are missing some of the key European carriers. I mean, Air France have suspended operations, BA are not starting, and I think that's mainly because of advice from their governments. They are having difficulty getting insurance for operations to the region. It's not related to any specific issue. But a lot of other airlines have made satisfactory arrangements for insurance, and they're continuing to operate as per normal.
In terms of the damage that was done to DXB, is that all fixed? Was it expensive to fix? Are you making any changes that will harden the airport effectively and make it more robust?
Well, let's get it in context. We had something like 111 missile alerts during the conflict, and we had something like 16 missile impacts in our infrastructure. There are a couple of things that will take a little longer to fix, but most of them were fixed within a couple of hours of the incident happening. None of them have hampered our operations in any way, and we've been able to operate pretty much full capacity throughout the entire period.
That was Dubai Airport CEO Paul Griffiths speaking with Bloomberg TV anchor Guy Johnson at the Farnborough Air Show yesterday. Very active there. Now, coming up, we're staying with air travel. The chairman of Turkish Airlines tells us he's seen a strong recovery path since the start of the Iran war. We'll get the details on what's next for the carrier next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. The chairman of Turkish Airlines has told us the recovery path since the start of the Iran conflict has been, quote, strong, and that the airline was able to keep up momentum during trying times. Bloomberg's Guy Johnson spoke with Murat Çeker at the Farnborough International Air Show yesterday.
Since the beginning of the crisis, like end of February, we were a little bit more worried because we are physically close to the hot zone, if I may call it that way. But the Ramadan holiday, the Eid that we had, and then the Easter afterwards, we saw a little bit of an impact of it, but then the recovery path was strong. Despite of the fact that Middle East makes around 6% of our overall capacity, we were very quick to relocate that capacity to the other places where the demand kept the momentum. In particular, Far East region and then South Asia, we saw a very strong demand, and we added about like 40 additional frequencies, namely to the Asian countries, some African countries, even some European countries where the demand was holding up. And then overall, we were able to put about like a 5-6% capacity growth on top of last year in the first half of the year.
Is that capacity coming out of the Gulf carriers? Are people not going via the Gulf, they're going via you?
A little bit of that, definitely, but we are not the only airline that took part of that capacity. Moreover, it was for an interim period of like 2-3 months, and then since I could say mid-June, we are seeing the Gulf carriers are almost full back into operation. So that extra demand we were getting from the Gulf carriers is gone. It's just like back to normal, I might say. But still, there is some hesitation probably on some potential leisure travelers.
What about the last few days? Have you seen any shift in demand then?
This thing, I think people are definitely cautious to travel, but it is not as strong as the first phase of the war. So people are more reluctant to cut their planning. But definitely we have seen the horizon has shortened. People don't make anymore like 2-3 months in advance reservations for their summer plans. They make like up to 40 days at most.
So visibility is being reduced. So what can you tell me about what the rest of the summer looks like and what maybe into the autumn looks like?
I mean, actually, from today, when I look at the rest of July, August and September, we are slightly above last year, so it shows that the traffic is holding up. But the visibility drops significantly for the last quarter of the year. Into October, November, we see that we're seeing the reservations are below last year. So people are waiting to have a more clarity as they get closer to their travel times. They're making the bookings.
And what's happening with fuel prices?
Fuel prices has been definitely very volatile. We hedge up to 50% of our 26 consumption. That's part of our regular strategy we have been implementing through many, many years. So it is providing some reservation, but more importantly, we were also able to increase the fuel surcharge on ticket prices. There are certain destinations where we were able to increase the price up to 20%, the ticket price.
That was Turkish Airlines Chairman Murat Şeker speaking to our own Guy Johnson at the Farnborough International Air Show. Now, Boeing secured almost 150 orders on the opening day of the air show after sitting out last year's event. The bulk came from jet lessor SMBC Aviation Capital, which bought 100 737 MAX jets. Saudi Arabia's Riyadh Air and Philippine Airlines also placed orders and options on 787 Dreamliners.
We're turning the corner. I tell my team we haven't quite finished turning the corner. We've got more work to do, but I am pleased with the progress so far. We're ramping up production across many of our product lines. Markets are very strong. So our backlog is very, very strong. So our story is really focusing on executing that backlog.
Meantime, Airbus also sold 100 of its A320neo to SMBC Aviation Capital and firmed up options with Riyadh Air for 6 wide-body A350-1000 jets. The European plane maker says the conflict in the Middle East has boosted demand for fuel-efficient aircraft. CEO Guillaume Faury promising the next generation of narrow-body airplanes will be in service in the next decade.
We want to be going to the market in the right timing, when we are ready, when the technologies are ready. We have already said and we confirm that we want to launch the next generation single aisle in 2030 for an entry into service in the second part of the next decade. Okay, so that's a bit more than 10 years away, which in our time frame is almost tomorrow.
And our coverage on the ground from the Farnborough International Air Show will continue with insights from the biggest players in the industry throughout the day. Bloomberg will be speaking to Leonardo's CEO, Lorenzo Mariani, Jefferies Senior Equity Research Analyst, Sheila Kayaholu, Lockheed Martin Aeronautics President, Orlando Sanchez, and GE CEO, Larry Culp. A really packed day for our team on the ground there. This is Bloomberg. Welcome back to Horizons Middle East and Africa. Frontline health workers in the Eastern Democratic Republic of Congo may soon be offered an experimental vaccine against the latest outbreak strain of Ebola. The proposal involves using existing vaccines for other Ebola strains to see if it could provide partial protection before a strain-specific vaccine is developed, which remains months away. Senegalese President Bassirou Diomaye Faye has begun the process of turning his coalition of supporters into a political party in a bid to consolidate his power base. The move comes after Faye split with former ally and Prime Minister Ousmane Sonko, who had previously supported Faye's rise to power via his political party PASTEF. And China Civil Engineering Construction Corporation has won a contract to build a $2.7 billion railway project in Tanzania that will connect the nation to some of its landlocked neighbors. The Tanzanian government aims for the 506-kilometer railway to link its main port of Dar es Salaam to Burundi, Democratic Republic of Congo, and Zambia. That is it for Horizons Middle East and Africa. Stick with us, of course, for Daybreak Europe. That's up next. This is Bloomberg.